Hi everyone, I am Chandler Lilly. I'm a junior business administration scholar concentrating in finance at Florida A&M University, hailing from Nashville, Tennessee. And welcome to a student's intro to alternative investments, where we learn from leaders in the alternative investments industry. Today we're exploring the energy sector with Mr. Matt Iak, an executive vice president of U.S. Energy Development Corporation and a board member of ADISA. Since joining in 2005, Mr. Iak has raised over $1.6 billion and developed investment structures such as Energy 1031 exchange funds and qualified opportunity zone funds. He also leads U.S. Energy's managing broker-dealer, Westmoreland Capital Corporation, and serves as a president for various family real estate firms. As a Kansas College graduate, Mr. Iak holds multiple FINRA licenses and frequently speaks on oil and gas economics, taxation, and financial planning. I'm glad to have you here today. How are you feeling?
I'm feeling great, Chandler. Very excited to be here. Thank you so much for having me. Excited to offer any advice I can.
Of course, we're glad to have you here, and now lead us to our first question. What initially drew you to the energy sector, and how did your experience as a financial advisor shape your approach when joining U.S. Energy Development Corporation?
It's taking me back in time. So I think I got fortunate as a young man coming from the financial sector. I sold my practice all the way back in 2003. And I was fortunate enough that my mentor happened to be my father-in-law and my mother-in-law. And they had helped me at a very young age build a large practice in the financial services industry. And so when the opportunity came, I went to them and we started talking about different ventures that I was approaching. And he at the time had owned a large and successful real estate company and a small oil and gas company that was his kind of passion. I won't call it side project, but it was kind of his passion, and much smaller company and something that he really loved to do. And he called me Kramer. I literally showed up one day. He never hired me, and I never left. And so the opportunity set. I was very long, in my view, on the energy sector at that point in time. As a finance professional, I really believed that natural gas was positioned in a certain position that it was going to take off, which was most of our firm at that time was a natural gas focused upstream, what's called E&P, exploration and production company. And so it fit my inclination. And then as I learned from him this beautiful world of capital formation and finance, it was kind of a perfect fit for what I love to do. And I think my first ever experience was actually at which was then a ticket conference, as I went to, which was more real estate focused at the time. And I really learned how people syndicate, structure, underwrite, and it's taken off since then.
So gotcha, that's good to hear. And I'm hearing you mention a lot about capital formation process, so that'll lead me to my next question, which is, you've overseen $1.6 billion in capital raises since 2005. What effective strategies, or what's been the most effective strategy in attracting capital, especially in the oil and gas space?
So it changes. To answer your question, currently it might be a different answer than it is 6 months, 2 years, 5 years from now. I think you have to be nimble in understanding what your ultimate clients want. And those needs and desires will shift with capital markets. So as an example of that, there can be times where the desire for yield is a primary driver for investment. And if you really want to be creative as an investment company, you want to see if what you ultimately do in that sector, so for us, energy, if you can design funds that take advantage of the desire or the arbitrage that's in the sector and couple that with what investors want. So for us, things like you mentioned before, the ability to navigate around opportunity zones, where clients have this desire for tax-free both income and growth and whatnot. If something overlaps with the sector, like the opportunity zones do, it becomes something that we take a lot of pride in working diligently to design, underwrite, and structure funds that capture both the investor desire and what you can do in the energy space. And I think what makes us unique, and I think what has been so special at U.S. Energy, is kind of marrying those two things. We really look at the world from both an operating oil and gas company, but also as an investment company, and where we can marry those two to find the best end result for clients.
Understood. So you mentioned a lot about opportunity zones. A big focus point for your firm is taking advantage of these tax codes and leveraging these for your clients and having them come on a GP. So I more so want to dive deeper into that topic. How do you approach constructing and underwriting new investment structures, such as Energy 1031 exchange funds or qualified opportunity zone funds?
Yeah, so at the end of the day, our client base tends to be wealthy individuals, right? That's who's best fit for a lot of alternative investments, right? Because they have the ability to invest in illiquid securities that meet their desires and needs. So with that backdrop, there is a commonality that a lot of wealthy clients really hate paying taxes. In fact, I'd probably be fair to say all of them hate paying taxes. Right. So maybe a few exceptions here or there, but most of us have this desire to keep what's in our pocket, or at least what we think is our fair percentage of it. So for us, when you can design something that is desired by clients, so specifically, one of the things that is one of the greatest parts of the tax code, has been for a really long time, and has really promoted the real estate industry to be what it is 1031 exchanges. Right? So that tax code exists out there. Well, one of the nuances is that oil and gas is real property. It's no different than any other real property, and through the TCJA and the 86 Reform Act and all the different tax codes, the real property has stayed with oil and gas because you get physical deeded title to that land. So those type of investments can be designed to be an oil and gas investment. So for us as a company, we look for the opportunity that says, okay, are the mineral rights, which are the best asset to exchange, not really drilling new wells, but actually owning the physical land, is the market there from an economic standpoint? Can you buy those assets at a price that investors will get their desired yield, their desired returns? And if those two things overlap, the desire from clients to have something like this, and then the return profile, we'll go to work and design the two. And for us, that's cyclical. Right now, 1031s are something we do quite a bit of, but there's oftentimes in the market where minerals are too expensive, in our view, or too risky in our view, and so we won't design those funds. Even though the tax codes still exist, there has to be a good underlying investment, right? So part of what we do is we push from both sides of the equation. We're constantly asking the hundreds of professionals that we have on the exploration and production side of the business, where's the arbitrage, where's the return, where's the best risk-adjusted return? They'll tell us it's in land, it's in drilling new wells, it's in buying existing companies, whatever that is. And then we'll go on the other side and say, okay, does this marry to a great tax arbitrage? And can we combine the two? Sometimes you can't. You just design more of a private equity fund that doesn't have any tax benefits. But if you can, like in a 1031 example, then we do that. OZs, other examples where certain parts of the capital stack or investable parts of oil and gas or renewables or any energy overlap with tax code, that's what we really look for, and then we try to attack that.
I understand that you're a big player in the energy or investing in the upstream process. So what's the firm's long-term strategy for navigating the energy transition while maintaining a focus on upstream oil and gas investments? And do you see an opportunity for renewable energy conversion within the sector?
So that's an awesome question. So for a backdrop answer, we're very much a believer in all of the above. For those who don't really understand the necessity for traditional fossil fuels, and this isn't a horse and buggy, we're going to need as much as we can get for as long as we can get. So that part of the business is extremely stable and something that we believe in, and we'll be here for an extremely long period of time. So yeah, we want to keep doing that. But we also love the renewable space. It's one of those things that it's a little bit harder for us at this point in time to find projects on the renewable side that compete economically with oil and gas. There's a lot of tax-driven incentives from the government. There's a lot of money and grants, but the heads-up economics aren't that great yet. So for us, we do those two things. Where is there a desire? Clients really want to buy it. So to go say I'm doing a solar project, the clients will line up. The question is, can you marry that with tax? Yeah, there are some great tax benefits on that side. And then can you marry that with economics? And currently there's just too much money chasing renewables. And in any sector, when there's more money than there is opportunity, then the returns can tend to get diluted. So there will be a washout in the renewable sector, just like there was in oil and gas 5-6 years ago, just like there is in every sector. And I believe there'll be a phenomenal entry point. And when I say we want to be all the above, I want to be just as well known for structuring renewable projects as we do traditional oil and gas. They just also have to make money. And that's kind of our barrier right now is, and there are parts of it, if you were a much larger company, an integrated company, where throughout all the different mechanisms where you can sell your energy and what you can do, that it can be economic. It's not really economic on a project level, developing a solar farm or a wind farm or XYZ. Someday I think it will. It'll probably require higher electricity costs and whatnot, and we want to be positioned to be just as well known. Our name is U.S. Energy. It's not U.S. Energy Oil and Gas, right? It's U.S. Energy. And I think there is a energy addition, not a transition, but an addition incoming. And where most of that additional draw is going to come is going to be from renewables. So you want to be in that space.
Understood. Great answer as well. And for students that may not know the end-to-end process of a deal or how you evaluate or what key KPIs you look for in a deal, can you just kind of take me through the thought process of analyzing a project or a deal, like just understanding what's attractive in a deal, what attributes do you look for?
In oil and gas, it's a little bit easier to answer because we do so much of it than it is to say in all the renewables, because there's just so many variations. But for us, my brother-in-law and I had the fortune of the prior generation of our company being my in-laws. And so we try to take all the best of what they taught us and then bring in what we do really well. What we do is we analyze data. And so for me, the most important thing of any deal or opportunity is, I'll use kind of an investment word, the standard deviation, the sigma, the difference of how far away from the type curve of return that you want it could be. And for us, we want the most repeatable, predictable, and that opportunity to be scalable. Those are kind of our big items. Can we do this? Can we do this over and again? Can we do this in large amounts? If any of those three aren't there, meaning it's phenomenal economically, but the standard deviation is huge. You could get huge returns or bad returns. We probably skip the projects. So repeatable is really important to us. Standard deviation is really important to us. And then the final one is this a one-time event? Or is this a partner, a JV partner, let's say with an oil and gas company that we can do tens or hundreds of millions of dollars with and stack them over years? That's much more important to us than a one-off good opportunity, right? I don't want to buy something from you and do it once because you're distressed. That's great for me or my investors, but that's not repeatable. Our main focus as a company is finding projects that we can basically operate like a manufacturing company that happens to be in oil and gas. And that's really what dictates our process.
Again, another great answer. I want to get into more of a controversial topic in the news, understanding that you're a big player in the upstream investment space. Within the recent debates, there's been big talks about fracking. I understand y'all kind of navigate in that space as well, and y'all kind of participate in hydraulic fracturing, and it's both seen as an economic driver and an environmental risk. How does U.S. Energy balance these two perspectives in its operations?
So I don't want to sound aloof when I answer this, because this will probably sound aloof. Fracking is probably the least environmentally concerning item in all of oil and gas. So it got a lot of attention, and unfortunately for those who put attention to it, it was just all bad. So the ideal horizontal fracking and fracturing is basically 95% of all wells in the U.S. are fractured. It's how you actually extract oil and gas. What you're doing is you're pouring water into a formation that is 8,000 feet below the earth and basically impermeable when you look at it. It just looks like rock. So what water does is between sand and water, you're pushing holes in that rock to allow the oil and gas hydrocarbons that are stuck in that rock to have a pathway back to a wellbore. You're only affecting a couple hundred feet around a well that's 8,000 feet below the water. So when you really think about your environmental impact is near zero. There are a bunch of environmental impacts in oil and gas, like tons. It's just not fracking. So when you bring that water back up, just think about everything that's naturally occurring in the earth. There's a lot of bad stuff down there, right? So when you build a house and you have radon, like I don't know if people, right, or radon, right? They have to build ways to extract that out so it doesn't harm you. Same stuff. When you pull water back up from fracturing or just natural water that would occur in a formation, what you do with that water is really important. And do you treat it? How do you treat it? Or if someone puts a forklift in the side of it and it spills into a waterway, there's real environmental, but the fracking itself is not, it's environmentally benign. It's all the processes and logistics that probably aren't much different than any other construction site of building a building or XYZ that are real environmental issues. And where does that water go off to and how do you treat it? And a lot of people would love to be cheap and not do anything with the water or you name it. I think there's a byproduct of that people didn't realize. In Oklahoma specifically, I don't know if you guys remember all the fracking news and was it causing earthquakes? So fracking isn't causing earthquakes, but when you frack and you pull that water up, what the states have you do is put it down back in the earth into old wells. So you go back and pour all that water back into another well, into a formation that accepts a lot of water, like a sponge, like an Arbuckle formation. When you do that, you're relieving pressure. Well, if there's a natural fault nearby, what's going to happen is you are going to relieve pressure on that fault, which can cause an earthquake. Now, a geologist would tell you that earthquake's going to happen anyways. You're just actually helping and speeding it up and lessening the magnitude. Okay, sure. But if you're doing a lot of them and causing earthquakes all the time, so they're byproducts of fracking, have environmental issues. It's not really fracking itself, but it gets all the drama. So it was a really long technical answer, but hopefully it was helpful.
That was very helpful. Thank you for your insight and just guidance into understanding a simplified version of what fracking is and how it doesn't have as big as an environmental impact as people think it is. That's a common misconception.
If that's okay with you, I just want to make one statement, which is the one thing I'm probably most proud of is that the U.S. as an industry in the oil and gas has the highest standards in the world. And if anyone is going to drill for oil and the world needs oil, you want it done by the best actors. And the one thing I think people should realize that is the most environmental thing that you can do is let U.S. companies be the ones that actually extract oil and gas everywhere around the world. Because the standard of care at which they have to hold is far beyond everyone else. And it is the most environmentally sound thing to do is to have American capital go to work because of those high standards, right? And a lot of it's regulated by the government and whatnot, but it's so much better than having Russia, Venezuela, anyone else extract stuff from the earth because they do it without any care in the world. It's kind of like what you're seeing in renewables right now with lithium mining and slave labor. And it's horrible, right, for renewables. Great cause, horrible actions happening behind it. I feel like the U.S. has the best standards of care, and we should really step up and say, actually, to be truly environmental, we should be giving U.S. companies all the capital and forcing them to hold all the activity so that we have these higher standards.
Thank you for the additional insights as well. I want to ask about the subsidies that the U.S. offers. There is a common misconception of how they're structured or how you kind of will utilize them as an oil and gas company. Could you give a little insight as to how the subsidies work from the U.S.?
Yes, so the tax subsidies, the biggest part in the code has been these deductions. The easiest way to equate it, it's like depreciation. So when they pass laws that like bonus depreciation for real estate or for any other company, it allows people to accelerate the time they take a write-off. That's in essence, oil and gas since 1913 has had this part of the code that allows non-integrated, meaning not the majors, other companies to take or flow through losses for things called intangible drilling costs, which is basically the money you spend on the well, you're able to write off as if it was first-year depreciation. So it's a really favored item from a tax perspective. It's not a credit. It's not XYZ. And ultimately, all that revenue is coming back to the states and to the government. So it's more of a timing benefit that a lot of investors take advantage of and a lot of oil and gas companies take advantage of. But there's no real large subsidies going out to the oil and gas industry. There's almost none, actually. Versus when you talk about renewables and you talk about the tax credits, you're talking $5 to $7 trillion going into the renewable sector and almost zero going to oil and gas.
Gotcha. Thank you for that different perspective on the issue. I want to now navigate to AI. As artificial intelligence is a big thing in the news right now, it's creating many industry tailwinds in various sectors. Do you see any growth opportunities or synergies within oil and gas investments and investing in AI?
So the answer is going to be for every company in the country, it better be yes. Right. AI is going to be important, whether it's the chains of logistics that are going to improve. Well, from an energy perspective, just the energy draw alone, if you think about the consumption of what AI is taking for, the only real solution to provide the energy that's necessary for this AI revolution is going to be natural gas. There is no other solution. You can't build enough solar or wind that'll make a drop in the bucket. So from a utilization standpoint, but on the other side, what you're asking is how does it affect the industry? It's going to revolutionize most industries, right? From how many employees you need. Just think about a financial analyst and how many analysts most companies like ours would have. We're littered with financial analysts. Well, a lot of that work can be done in hours that it would take 12, 15 humans weeks to do. It's scary, right? So there's the job part of it, the efficiency part of it. There's a whole host of it. And then there's also the difference of open AI and captive, right? And are people going to use any open AI or captive? So I use it even as something as nuanced as reviewing a private placement memorandum, a PPM, of myself, competitors, XYZ. I can do it in seconds. I can have all the key items taken. Now, I wouldn't do that in OpenAI because I wouldn't want that out to the world. But in a closed setting, it can give me all the feature structures, fees, costs, you name it, in seconds. And that's just one function, much bigger than that across every company. But if you're not using it, marketing, sales, logistics, engineering, I think everyone's going to be missing out who isn't utilizing it.
So there's been a kind of bigger frenzy around AI energy consumption, especially in AI data centers, and how can we kind of mitigate that risk of not kind of running out of energy sources? So have you really evaluated that area, or do you have much insight or stance on that topic?
So I would again say I think AI and the amount of energy consumption is astronomical, right? When we just look at how significant this is going to be, I could sit here and talk to you about all the cool technologies and the ethanol coming from sugarcane, and we could talk about renewables. The reality is, when you really boil it down, modular nuclear will eventually have a place. And I think they've recently talked about reopening 3 Mile Island from a nuclear standpoint. So I think nuclear is going to play a part of the stack. I do. Problem is, that's 15 to 18 years. but to get something approved online. For the next decade or two, I think the only solution, and the real solution, is going to be natural gas. We are blessed in this country of being the world's largest natural gas reserves. I would call it almost infinite in quantity. Hundreds and hundreds of years of production of natural gas under the current technology as we know it. So I think we are blessed in that we can build the infrastructure, we can extract it reasonably low cost, and it is super clean. It is not only BTU heavy, meaning it actually produces an immense amount of energy and efficiency, but bigger than that, it's about as clean, if not perfectly clean, based on what the technology is that's out there. So it is environmentally sound, friendly, and we have so much of it that I think it is ultimately the simple solution to build the infrastructure in natural gas alongside the AI and have this just be a self-fulfilling prophecy of us leading the world. Everyone else is going to have to compete to get that energy. So if you're building those same AI data centers in China, they're going to have to use coal, and they're going to have to use dirty fuels, or they're going to have to import natural gas from somewhere else. We literally have it at our fingertips, and it's unlimited, abundant, easy, and super clean. So my answer is we already have the built-in and embedded solution that nobody else has.
Gotcha, understood. Thank you for that answer as well. My next answer is going to like cyclicality. I want to kind of go back in the past a bit to 14 and 15 when the industry kind of took a big hit on oil and gas, and with the ExxonMobil incident as well. How did you kind of navigate yourself through that kind of economic downturn in a way, or any other ones like such as COVID or the Great Financial Crisis? How did you kind of navigate, and what challenges did those present for your industry?
So great question. Unfortunately, or fortunately at the time, my father-in-law had just passed. So myself, my brother-in-law, my partner, we had the luxurious position of being in an industry that went from super profitable to overnight getting decimated. And that was the exact time that we took over. So I think it was a blessing for us because we very quickly were nimble. We implemented a whole lot of see-through technology to be able to shut down production in areas that was unprofitable, to move things much quicker. We made massive strides. We cut all of our G&A by almost 60%. Without firing people, we all took salary cuts across the board. And I think our ability to be nimble was absolutely critical, that we weren't one of the 280 companies that went bankrupt. Because the oil and gas industry was littered with bankruptcies in that period of time, in this massive reshape. After years of too much capital coming in the industry, being spent willy-nilly, it was time to come home. And then on top of that, you had collapsing prices, banks pulling all their capital. It was just an unbelievable and unmitigated disaster. For me, it was the best thing that ever happened. One, when COVID happened, we were already prepped. We had already had these technologies in place that we could shut down wells within hours. Anything that was going cash flow negative on prices, we could move very quickly and be very nimble as a company. And it actually put us in position for insane success coming out of it because we were nimble in what we do as a company from an operational perspective. So the 15-16 debacle put us in a really fortunate position, and it also helped us from an investment side. We've always been very good at raising capital, and we were able to raise capital when everyone else was running away from the industry, which means we were buying assets at the absolute best time, which multiplied into great returns on the backside. So we were very fortunate in how my father-in-law and I had built the investment network, and that we could still draw on capital when no one else could. And that was really fortunate in COVID and in 15-16, and even now. But that during those down times, being able to buy assets when everyone else is distressed and invest, and one, it builds you great partnerships with a lot of public companies that we wouldn't have had otherwise. And so the opportunity and the preparedness hit each other, and we really came out of the other side just flying because of those downturns. So I love those downturns. They create big opportunities. I love volatility in price. I love all of these things because ultimately it creates a better atmosphere to create better risk-adjusted returns. So I think we're well positioned for the next one. You always have to be ready, right? You have to be able to ready to do what it takes to very quickly maneuver. And I think being nimble is super important.
Got you, understood. And that's a great perspective to add on. It's actually really impressive how you kind of deconstructed or dissect your business model and kind of reevaluate some things, to structure some things around to understand how to survive during a really tough and aggressive time in the industry. And I want to thank you for that additional insight of just taking us through your thought process of how to kind of survive in that time period. Just to further wrap up our session, I'll put 2 questions. What advice would you give to students interested in the alternatives industry and furthermore the energy sector?
2 separate questions. The alternatives industry, I will tell anyone who's fortunate enough to find it, being in the investment underwriting structure sales of alternatives is probably the most interesting, dynamic, and fun career you'd ever imagine. The opportunity to make money is probably better than anything you could imagine. The opportunity to enjoy what you do every day is off the charts. You want to have to work hard. If you don't want to work hard, it's a really bad industry. The hours are fun. You'll be up till midnight, 2 o'clock in the morning, and the next day speak at 7 a.m. And you have to be on your game 24/7, travel all over the world. Sounds great, but after decades, it can be exhausting. But I will tell you, there's nothing more intellectually challenging, interesting. Anyone who walks in is fortunate enough to walk into this world. You will never find a comparative, and this comes from a guy who's been all over finance, in any other field. So I would tell everyone, look at it hard, find an opportunity to walk in and do not let it go. Very different from energy, which as a sector, I think a lot of the younger generation is going to be much more drawn towards what they believe is the future, which is going to be the renewable side. So I think you're going to have a lot more interest. I would actually tell people that fossil fuels are going to be here for the next 50 plus years. If you take an interest in it, you're probably going to be one of a very select few in a field where intellectual capital is paid a premium. So I would actually tell the young people to look at it as a all of the above strategy. And if you're equipped to deal with most companies, I think are going to not be exclusive to just oil or gas or renewables. I think you're going to see the most successful ones have divisions in all of them. And I would tell people to be prepared to understand the whole stack, not just the next stack of what is happening with renewable or X or Y or Z. I think you're missing out on one of the greatest opportunities. And there's been a dearth of great employees at multiple times in oil and gas because of the cyclicality. So, in the 80s when you're doing really well and then it drops precipitously and stays low. And then again in 2006, you go through all these major super cycles of lower prices longer. There's generational gaps where there's just not great employees at certain age groups because no one in the colleges was going to study reservoir engineering during those years. So I think it's a huge opportunity set for you to be where others aren't and in essence be in the energy space. Again, very different. I do less of that personally. I'm much more on the investment side. And I will tell you, if you're in finance, especially on the wholesaling and the security side, it is probably the coolest opportunity you'll ever find.
Thank you again for your answer. And just to end us off on our last question, as someone with a multifaceted career, what's next for you in terms of professional development or new projects you're excited about within the energy or financial space?
So what's next? I think U.S. energy is going to constantly evolve. So this is what's next for us. I do a lot of real estate as well. So for me, I love investing. And any field at which I can find a vertical that pairs up to what we do, I usually go out and I hire a lot of great people first, build the infrastructure of great humans, and then we'll build out a business unit and a thesis as we go. So a lot of different real estate ventures that I do now that we've been building out for the last couple of years. I believe the opportunity sets ebb and flow. There's some really good entry points here as there's been some stress in the market. But I think as an energy-focused firm, we'll constantly just be nimble in looking for that best arbitrage and where the best part of the energy capital stack, whether it's buying companies, buying assets, drilling fields, co-developing with major, it doesn't matter. We'll shift that every 5-7 years for where we see the best net set of opportunities. And so I just love it every day, and I don't plan on doing anything other than this until my kids someday, I guess, kick me out.
Gotcha. That's a great perspective to add. I want to thank everyone again for tuning in, and thank you as well, Mr. Matt Iak, for your time today. You're a very busy person serving on the board and as well as the executive director position at U.S. Energy. So glad you joined us for this insightful conversation on energy with Matt Iak. If you enjoyed this episode, please subscribe to our channel, and we'll be back soon with more expert insights and student perspectives on alternative investments.